In the world of money, every decision you make shapes your future. From the smallest savings habit to the biggest investment move, finance is not just about numbers. It's about understanding how money works, grows, and sometimes disappears. Imagine stepping into a marketplace where every stall offers a different way to build wealth. Some are safe and steady, others risky but rewarding. This is the world of investing, and each path tells a different story. If you like my videos, don't forget to subscribe. Stocks. Stocks represent ownership in a company, making you a part owner of businesses that could span industries like technology, healthcare, or energy. When a company grows and earns more profit, its stock price often rises, increasing the value of your investment. Some companies also reward investors with dividends, offering a share of their earnings. However, stocks are influenced by market emotions, global events, and company performance, meaning prices can rise and fall quickly. For long-term investors, they are often the foundation of wealth creation. Bonds. Bonds are like a promise. When governments or companies need money, they borrow it from investors through bonds. In return, they agree to pay regular interest and return the original amount after a set period. Bonds are generally more stable than stocks, making them attractive to those who prefer steady income over high risk. However, their value can fluctuate with interest rates and inflation, meaning they are not entirely risk-free. Mutual funds. Mutual funds bring together a group of investors, pooling their money into a single fund managed by professionals. Instead of choosing individual stocks or bonds, investors rely on fund managers to make decisions. This creates instant diversification, reducing the impact of a single poor-performing investment. While convenient and beginner-friendly, mutual funds come with management fees that can slowly reduce returns over time. Exchange-traded funds, ETFs. ETFs combine the best of both worlds: diversification like mutual funds and flexibility like stocks. They trade on stock exchanges, allowing investors to buy and sell them throughout the day. Most ETFs track an index, meaning they aim to match the performance of a broader market rather than beat it. Their low fees and transparency have made them one of the most popular investment choices in modern finance. Real estate. Real estate is one of the oldest forms of investment, rooted in the idea of owning land or property. Whether it's a small apartment or a large commercial building, real estate can generate income through rent and grow in value over time. However, it requires significant upfront capital and ongoing maintenance. It is less liquid than stocks, meaning it takes time to sell, but it offers stability and tangible value. Real estate investment trusts, REITs. For those who want exposure to real estate without managing property, REITs provide an alternative. These companies own or finance income-producing properties and distribute most of their earnings as dividends. They allow investors to benefit from real estate markets while enjoying the convenience of stock-like trading. REITs are especially appealing for those seeking regular income. Cryptocurrencies. Cryptocurrencies represent a new frontier in finance. Built on blockchain technology, they operate without central control, offering a decentralized way to transfer value. Bitcoin, for example, is often viewed as digital gold, while other cryptocurrencies enable complex applications. Despite their innovation, cryptocurrencies are highly volatile and influenced by speculation, regulation, and technological change, making them both exciting and risky. Commodities. Commodities are the building blocks of the global economy, including resources like gold, oil, and wheat. Their prices are driven by supply and demand, geopolitical events, and environmental factors. Investors often turn to commodities as a hedge against inflation, as their value tends to rise when the cost of living increases. However, they can be unpredictable and do not generate regular income. Index funds. Index funds follow a simple philosophy. Instead of trying to outperform the market, they aim to match it. By tracking a specific index, they provide broad market exposure with low costs. Over time, this passive approach has proven effective for many investors, offering steady growth without the need for constant monitoring or decision-making. Options. Options introduce a layer of strategy and complexity. They give investors the right to buy or sell an asset at a set price within a specific time frame. This flexibility allows for hedging against losses or speculating on market movements. However, options require a deep understanding of market behavior, as they can amplify both gains and losses. Futures. Futures contracts are agreements to trade assets at a future date for a predetermined price. Originally used by farmers and producers to manage price risk, they are now widely traded by investors. Futures often involve leverage, meaning a small investment can control a large position. This creates opportunities for high returns, but also significant risk. Private equity. Private equity operates behind the scenes, investing in companies that are not publicly traded. These investments aim to improve businesses over time and eventually sell them for profit. While private equity can deliver strong returns, it requires patience, large amounts of capital, and a willingness to accept limited liquidity. Hedge funds. Hedge funds represent the most sophisticated corner of the investment world. Using advanced strategies like short selling, leverage, and derivatives, they seek to generate returns in all market conditions. They are typically reserved for wealthy investors due to their complexity and high fees. While they offer the potential for high returns, they also come with significant risk. As the journey through finance comes to an end, one thing becomes clear. There is no single path to wealth. Each investment type carries its own story, its own risks, and its own rewards. The key is understanding these choices and aligning them with your goals. Because in the end, financial success is not about chasing trends. It is about making informed decisions over time.